All right, Vince is going to play us a quick song. Go and take a break. Go grab some water. If it's some morning time, maybe some coffee, some tea, some juice. For those of you, it's the evening time, a glass of wine, whatever your favorite drink is. Stretch, go use the restroom, and we'll see you here back here in about 2 to 3 minutes.
They say 95% of successful men had a good woman behind them. So this one's for all my real queens out there holding it down for their men trying to build their own empire who can't do the 9 to 5. Ladies, on behalf of all the founders out there, we just want you to know that we appreciate the sacrifice. That really keeps us going. Late nights, early shifts, barely caught sleep. Empty fridge, but her love kept me on my feet. Used to check my balance, praying numbers would rise. She never rolled her eyes, just saw a king on this grind. No bags, no trips, just a vision and some stress. Told her one day we gon' flex with no debt. A woman's biggest test is when her man ain't got a thing. For us it's when we reign supreme and can have anything.
I know the weight that you carry inside. I see the vision, baby, I'm down for the ride. I can see the future and it's looking bright. Just keep pushing, baby, I'm always by your side.
Numbers start moving, proud of getting traction. Late nights still working, but I feel the shift happen. First big deal, put the profits back in. Told her we ain't there yet, gotta stack and expand. Investors on the line, now they trying to get a piece. But I told her we stay patient, we gon' own this whole feast. Bills ain't breaking us now, but the stakes still high. Told her, baby, hold on tight, we just inches from the sky.
I know the weight that you carry inside. I see the vision, baby, I'm down for the ride. I can see the future and it's looking bright. Just keep pushing, baby, I'm always by your side.
I remember late nights stressing, now it's 5-star plates. Used to budget every dollar, now we buying real estate. Paris in the fall, Santorini for the summer. Ain't no budget when we land, pick whatever, it's my honor. Could've left when it was dark, but you stayed, that's rare. Now you flexing in designer while they stop and stare. Wasn't just me, girl, we built this as a team. Wouldn't be here if you ain't bet it all on me.
I know the weight that you carry inside. I see the vision, baby, I'm down for the ride. I can see the future and it's looking bright. Just keep pushing, baby, I'm always by your side.
Not everybody gonna understand the vision from the start. The real ones, they see past the struggles, past the late nights, past the setbacks. She ain't just here for the wins, she here for the grind. The losses, off the build up. She held me down when the scoreboard said 0. Now she riding shotgun while we count up the blessings.
All right, guys, welcome to session 2 of week 5B. We are officially over the halfway mark. So we're coming down the hill, which is good. In this one, we're going to be talking about DEXs, AMMs, liquidity pools, and Uniswap. All right, the goal of this session is to understand how DEXs work under the hood and how swaps happen. And Charisma, let me know if my camera is good. I don't have my elevator here. So before we can understand how Uniswap or any decentralized exchange works, we need to understand what problem it's designed to solve first. And Charisma kind of touched on this. So for decades, financial markets have been powered by order books, right? Exchanges specifically. And this is used by not just exchanges, but Forex markets, centralized crypto exchanges like Coinbase and Binance. Basically, buyers place bids and sells. They place bids, sellers place asks, and a centralized system matches them. It's like matchmaking. It's almost like picture someone in the middle like, hey, all right, he's willing to sell it for this. He's willing to buy it for this. All right, this is the closest match. Run it. I'll keep a little piece of the transaction, okay? But here's the key point. Like I said, order books assume a centralized coordinator. Someone has to host the book, update prices in real time, manage latency, and work with professional market makers to keep spreads tight. All right, that model works well in TradFi, but it doesn't translate cleanly to blockchains. Blockchains are slow compared to high frequency trading systems, at least most blockchains. Every system update costs gas, every transaction takes time, and everything must be verified by a distributed network. Right? Running a order book on chain would be expensive, inefficient, and easy to exploit. This is where automated market makers or AMMs come in, right? They don't try to replace Wall Street's infrastructure. Instead, they rethink what a market can be in a decentralized environment. So rather than matching buyers and sellers directly, AMMs use something called liquidity pools and mathematical formulas to set prices automatically, right? Anyone can contribute liquidity, and trades are executed against the pool itself, not another trader. So this section is about that transition, why order books were the default, why they break down on chain, and how AMMs emerge as a native Web3 solution. So once you understand this shift, Uniswap and DEXs in general stop feeling confusing, and they'll start feeling inevitable. Okay, so to understand why they exist, we first need to understand how these traditional order books work. And we kind of talked about this. So they have two sides of the market. Buyers going to submit the bid, which are the prices they're willing to pay. Seller submits the ask, which is the prices they're willing to accept. And where was I? And the exchange's job is to constantly sort these orders by price and time to match them when they overlap. Okay, so liquidity in these systems usually don't come from everyday users. It's provided by professional market makers. And these are firms with large amounts of capital and sophisticated trading infrastructure. Their job is to constantly quote and buy sell prices so that the market stays active and spreads stay tight. And like I said, this works well in centralized environments because everything happens off chain in real time, but it relies heavily on this centralized control, privileged access, and trust intermediaries, which means none of us can use it or benefit from it other than just being able to buy and sell things, but not be the market maker. So while order books feel familiar and efficient, they come with assumptions that don't translate well to decentralized systems, and that's where the cracks start to appear. So now that we understand how order books work, let's talk about why this model breaks down on chain, right? On a blockchain, every action is a transaction. Placing an order, canceling an order, or updating a price all require gas fees. And depending on what chain you're on, depends on what the gas fee is going to be. Layer 2s are typically more cost efficient. So in an active order book, prices change constantly, which would make on-chain order books incredibly expensive to maintain. And block time is another issue, right? Blockchains don't update instantly. There's a latency between when a transaction is submitted and when it's finalized. And that delay opens the door to front running in MEV, minor extractable value. We talked about this a few weeks ago. And this is where bots can see pending orders and jump ahead of them. Order books also assume a centralized coordinator to manage matching and sequencing that runs directly against the decentralized ethos of blockchains. So without a trusted intermediary, keeping an order book fair, fast, and secure becomes extremely difficult. So the problem wasn't that developers didn't try to put order books on chain. It's that the model itself wasn't designed for a decentralized environment, right? This forced DeFi to ask a deeper question. What does a market look like when you remove centralized matching entirely? And that is going to lead us directly into AMMs. Now, AMMs, they introduce a completely different way of thinking about markets, right? They remove the need for order books entirely. Let that sink in. So instead of matching buyers and sellers, trades are executed against liquidity pools that hold pairs of tokens like ETH and USDC. The price of assets in these pools isn't set by humans or institutions. It's determined automatically by a mathematical formula embedded in a smart contract. And as people trade in and out of the pool, the formula adjusts prices in real time, right? One of the most important shifts here is who provides liquidity. In traditional markets, market making is dominated by large firms, right? Citadel, Deutsche Bank, Goldman Sachs, Morgan Stanley, etc. In AMMs, anyone can supply tokens in a pool and earn a portion of the trading fees, and turns us, everyday people, into market makers, right? And the cool thing is that the institutional market makers, they're not legally allowed to provide liquidity in DeFi yet. And that's why, our DeFi challenge is doing so well, because we get to be market makers not only for the first time, but without the institutions. It's the first time where a financial product was available for the people first and the institutions last versus the other way around. All right. So AMMs weren't just a workaround, they were a redesign. They're a market structure built specifically for blockchains, simple, permissionless, and always on. All right. So now let's look at the math that makes this so basic, but also so powerful. And this is the constant product formula, right? And I know it looks technical, but we're going to break it down pretty simple here. So most AMMs, including early versions of Uniswap, use what's called the constant product formula. X multiplied by Y equals K. And here's what that means in plain English. A liquidity pool has two assets. So for example, ETH and USDC. The total amount of ETH is X, and the total amount of USDC is Y, and their product is K. The smart contract enforces the rule that this product must remain constant. So when someone swaps ETH for USDC, they add ETH to the pool and remove the USDC because the product must always stay the same. The price automatically adjusts. The more ETH someone tries to buy, the more expensive it becomes, and vice versa. So there's no order book, no negotiation, no human decision making. The price responds purely to supply and demand inside the pool, right? So this simple formula is what allows AMMs to function without centralized control. It's also why large trades cause price movement, which we'll later describe as slippage, right? So understanding this formula gives you a mental model for everything that happens on Uniswap and most DEXs. All right, first question. What is the primary role of an order book in traditional markets? I'll give you guys a couple seconds here while I pull up our demo video for later. All right, and 3, 2, 1. If you answered B, then you're with me. To match buyers and sellers based on bids and asks. Gonna switch it up on y'all. Question 2, coming back to back. Why are on-chain order books inefficient on blockchains? Why is it more efficient in TradFi than blockchains? You guys 5 more seconds. 5, 4, 3, 2, and if you answer C, then you were correct. They require frequent updates that cost gas. All right, so now up to this point, we've been talking about market structure and math, why AMMs exist, and how prices are determined. Now it's time to bring this down to the user level and answer a simple question. What actually happens when you use a DEX like Uniswap? So from the outside, swapping tokens looks almost too easy, right? Connect your wallet, choose 2 tokens, and click swap. But underneath the hood, that buttons is a sequence of smart contract interactions that are very different from what happens on a SEX, right? So in this next section, we're going to walk through a Uniswap trade step by step. We'll look at how custody works, how smart contracts executes the trades, why gas fees exist, what trade-offs users are making, and what trade-offs users are making when they choose decentralization. So the goal here isn't to turn you into a trader, it's to help you understand what you're trusting, what you're paying for, and why DeFi works the way it does, okay? So let's break it down. What happens when you click swap on Uniswap? So first, you select the tokens, you choose what token you want to trade, and the token you want in return. For example, I want to trade ETH for USDC. Then you have the calculation. So the smart contract calculates how much of the output token you'll receive using the constant product formula that we went over, right? This is going to determine the price based on current pool balances. Number 3, the token transfer. So your input tokens are sent to the liquidity pool, and the pool sends you the output tokens. Everything happens atomically, meaning either the entire trade goes through or none of it does, right? And then lastly, on-chain record. The transaction is immediately recorded on-chain. There's no middleman, no settlement period, and you retain custody of your tokens throughout. So from a user perspective, it feels simple and instant, but behind the scenes, the smart contract ensures trustless execution, enforces the pricing formula, and handles all the transfers automatically. So this is the core of how AMMs make decentralized trading possible. It's predictable, transparent, and permissionless. Now, one of the most important differences between a SEX and a DEX is custody. On a centralized exchange, you deposit your tokens into the exchange's wallets, right? You're trusting that the exchange is secure, solvent, and acting in good faith. Unfortunately, though, history has shown us that trust can be broken, right? Exchanges get hacked, they go bankrupt, and they even freeze accounts. On a DEX, however, like Uniswap, you never give up custody of your tokens. Your wallet interacts directly with the smart contract, which enforces the rules of that trade automatically, right? The contract moves the tokens, it calculates the price, and it settles the trades, all without a human. And this is what people mean when they say trades are trustless. You don't need to trust anyone. The code itself ensures that your trade executes exactly as promised. So understanding this principle is crucial for evaluating DeFi protocols. It's not just about swapping tokens. It's about designing financial systems where you remain in control and the rules are guaranteed by mathematics and code. And smart contracts are the backbone of not just Uniswap, but any DEX. Think of them as like digital vending machines that execute pre-programmed instructions perfectly every time. When you perform a swap on Uniswap, the smart contract enforces the rules of the trade automatically, right? It ensures the constant product formula holds, calculates slippage, and applies any fees. It handles the token transfers. Take a sip of water. So it handles the tokens transfers. It moves your input token into the pool and sends you the output token all in one atomic operation. This ensures you to get the full trade or nothing happens at all, right? No partial fills, no human error. And then smart contracts are open and auditable. Anyone can look at the code and see exactly how it works. You don't need to trust a company, broker, or employee. You can verify everything for yourself. And the beauty of smart contracts is that they replace intermediaries with code that cannot cheat or forget, right? They turn complex financial operations into predictable, transparent, and automated processes. And this is exactly what makes DeFi so powerful. So understand that smart contracts help you see that AMMs aren't just a trick. They're a fully programmable market design that anyone can participate in. Now, even though swapping on a DEX feels simple, there's real world costs and trade-offs that every user should understand. The first one is gas fees, right? Every transaction you send to the blockchain requires computational work, which miners or validators are paid to perform, right? So on networks like Base, fees are very low, but on Ethereum mainnet, they can get expensive during congestion. Okay, so next one is slippage. Since AMMs use liquidity pools, the price you receive depends on the size of your trade relative to the pool. So that means large trades will push the price against you. And this is why you might see a different amount than the quoted price when the transaction executes. And then finally, there's a trade-off between convenience and decentralization versus cost and price certainty. So AMMs let anyone trade directly from their wallet without a broker, which is powerful. But because it's on chain and automated, you must account for fees, slippage, and potential delays. So understanding these trade-offs helps you plan your trades smarter and recognize the limitations of AMMs rather than just focusing on seamless user experiences. Question number 3. Why does slippage occur on AMMs? You guys tell me. I have no idea. All this stuff is new to me. I'm just kidding. I'll give you guys about 5 more seconds here. Okay. YouTube's being weird. Okay. And the correct answer is going to be, I already said it, B. Because the trades can change pool ratios. So up to this point, we focus on how AMMs function from a user and smart contract perspective, how trades execute and how prices adjust, and what costs and trade-offs exist. So now it's time to shift our attention to the other side of the market, which is the people who makes these trades possible, right? So in TradFi, liquidity comes from large banks or professional market makers, and DeFi comes from anyone except those market makers because they're not legally allowed yet. So this section is going to walk you through liquidity pools, how tokens are pulled together, and how participants called liquidity providers or LPs earn a share of trading fees. We'll also touch on some risk like impermanent loss, which you'll explore more deeply in later sessions. So the goal here is to understand that AMMs aren't just code, they're ecosystems sustained by participants who take on risk in exchange for yield. So once you see how liquidity is provided and incentivized, everything from trading volume to price stability starts to make sense. All right, so now, what is a liquidity pool, right? It's at the heart of any AMM. The smart contract, it's a smart contract that holds two tokens in a pair, for example, ETH and USDC. Anyone can deposit tokens into a pool, and when you do, you're adding liquidity that traders can swap against. Now, without these pooled assets, trades would be impossible. And this is why we often say liquidity is the lifeblood of a DEX and the lifeblood of financial markets, right? The pool isn't passive, it automatically adjusts prices. So it's going to automatically adjust the prices using the AMM formula we covered earlier. So as trades happen, the balance shifts and the contract recalculates the price for the next trader. And then you have pools that grow in size as more people contribute tokens and as trading activity generates fees. More liquidity usually means lower slippage, which makes the DEX more attractive to traders. So by the end of this slide, it should be pretty clear that the DEX isn't just a piece of software, it's a dynamic ecosystem powered by pools of real assets contributed by real people. Now, liquidity providers, or LPs as we like to call them, are the people who make AMMs work. So when you add tokens to a pool, you earn a portion of the trading fees generated whenever someone swaps against your pool. So for example, Uniswap charges a 0.3% per trade, which is distributed proportionally across all LPs based on their share of the pool, and if they're in range, which is another thing. In addition to fees, some platforms offer extra incentives like protocol native token rewards or staking bonuses to attract liquidity to certain pools. These rewards can significantly increase yield, but they come with considerations. It's important to remember that providing liquidity isn't risk-free also, right? LPs are exposed to something called impermanent loss. And this happens when the relative prices of the pool tokens exchange or change. And while fees and rewards can offset this, LPs must understand the trade-off between earning yield and market volatility. Ultimately, LPs are being compensated for taking on risk and supporting the trading ecosystem. Without them, AMMs can't function, right? Liquidity providers are the backbone of decentralized trading. Now, Uniswap v3 introduced a major evolution in AMM design called concentrated liquidity. So unlike previous versions where liquidity is spread across all prices, which made your capital not as efficient and sometimes wouldn't get used, which is why it's inefficient, V3 allows LPs to allocate their capital to a specific price range. This makes pools much more capital efficient because liquidity is concentrated where it's most likely to be used, right? It rewards smart liquidity providers. So in addition to concentrated liquidity, Uniswap v3 offers multiple fee tiers such as 0.05, 0.3, and 1%, and you can create your own custom one, right? LPs can choose which pool to provide liquidity in based on their appetite for risk and expected trading volume. And then lower fees attract more trades, but it reduces the LP earnings per trade as well. Higher fees, on the other hand, provide more yield, but may see less volume. So they kind of balance each other out in that way. Now, this level of control and sophistication allows liquidity providers to optimize returns and manage risk in ways that weren't possible before. And it also demonstrates how AMMs continue to evolve to attract liquidity while maintaining decentralized permissionless trading. Okay, now let's dive into a permanent loss a little bit here. And this is the most important concept when it comes to providing liquidity to even understand it at a high level. Now, this happens when the relative price of tokens in a pool change. So for example, you provide ETH and USDC to a pool and ETH rises significantly in price. Your LP position may be worth less than if you had simply held ETH and USDC separately in your wallet. The term impermanent comes from the fact that if the price returns to the original ratio, the loss disappears. And it actually could be profitable because you're going to generate fees that whole time. However, if you withdraw liquidity while prices have diverged, the loss becomes realized or permanent loss. Now, trading fees and extra incentives often offset impermanent loss, which is why LPs can still earn a net positive yield, even in volatile markets. We're not going to dive too deep here, right? This is the whole point of our DeFi challenge. We show you how to even use impermanent loss to your advantage, how to avoid it if you want to, and just different ways of looking at it so that you can create a strategy that aligns with your goals, your lifestyle, and just who you are as an investor and a person. Question 4. How do liquidity providers earn money? This should be an easy one. Give you guys a couple seconds here. Okay. And if you answered C, you were correct by earning a share of trading fees. Now, we've walked through AMMs, liquidity pools, and how Uniswap executes trades. It's important to step back and see the big picture. AMMs fundamentally changed how markets operate by removing intermediaries. You no longer need a broker or an exchange to trade assets. The smart contract enforces the rules, manages the liquidity, and executes trades automatically. Right? They're open to anyone, anywhere in the world. And if you have a wallet and tokens, you can participate as a trader or a liquidity provider, aka market maker. Right? This is a level of financial inclusion that traditional markets cannot offer and that humankind has never seen. Right? AMMs also automate pricing and liquidity provision, creating a predictable, transparent, and permissionless market environment. And this is why AMMs have become the foundation for the modern DeFi ecosystem. Many other innovations, from lending platforms to derivatives, built directly on top of AMMs. So understanding AMMs isn't just about swapping tokens. It's about seeing how DeFi fundamentally rethinks market infrastructures. So now, for your mission, what we want you to do is just initiate a small swap on Uniswap, right? Make sure you have some ETH for gas, and you can swap like some ETH for some USDC. And then we want you to screenshot or do a short write-up of the swap, including the input and output amount, and observe slippage and just your thoughts on it and maybe how it differs from buying stock on Robinhood or wherever you buy your other assets.